Kia ora, and welcome to the CoreLogic Property Market Update for Here Turi Koka 2022. As we move through the meaty section of this part of the property market cycle, things are getting interesting when it comes to some of the key influential fundamentals. The most pertinent one being interest rates, as some downward pressure via lower wholesale funding rates feeds through to the New Zealand market. Strong competition amongst banks is also a key factor here in terms of limiting any further interest rate increases lately. The likelihood of us being at the peak of the rising interest rate cycle remains small though, with further increases to the official cash rate still expected. Interest rates and their influence on borrowing power and therefore housing affordability remains key. Acknowledging the tightening credit situation, combined with increasing interest rates having been a major driver of reduced demand for mortgages and property, credit cost and availability remains central to expectations for the future of the market. Nationwide sales volumes remain 30% below the long-term average in July. This, combined with stock staying on the market longer and total listings remaining high compared to recent history, has meant further weakness for property values. The Ryan's House Price Index has recorded the fall in nationwide property values from peak to be 10.8% down since the end of 2021, with both the Wellington and Auckland regions falling by roughly 16% over the same period. The downward momentum has been consistently evident in the CoreLogic HPI too, with the monthly fall of 0.9% in July a touch larger than the 0.8% recorded for each of the previous 3 months. This culminated in a fall of 2.5% over the 3 months to the end of July, which is the largest quarterly fall since October 2008. Once again, the Wellington region appears to be faring the worst through this downturn, recording a fall of 3.6% over the month of July. None of the main centres were immune to weakness though, with even the previously more resilient Christchurch market also experiencing a fall of 1.6% over the month. For now, the downturn has been relatively controlled, which will be welcome news for the Reserve Bank, concerned with financial stability of our economy. With the cost of living and inflation remaining the number one concern for many, this paves the way for further cash rate increases in the fight to bring that inflation rate down. Relatively conservative lending practices, adhering to the tightest loan-to-value ratio restrictions on record, adjusting the CCCFA modifications, and implementing internal debt-to-income caps will also appease the Reserve Bank, who will be keeping a firm eye on how the housing downturn plays out. Their latest reporting on high debt-to-income ratios showed a further reduction in the more risky lending, with less than 4% of first-home buyers taking on debt greater than 7 times their income, down from 9% 6 months ago. Meanwhile, the tightening for investors has been even greater, accepting they have a higher start point. 41% of loans were above the ratio of 6:1 for this group, down from about 55% in late 2021. Higher serviceability interest rates also play a part in affecting the amount a buyer can borrow from the bank. Not to mention reducing confidence affecting sentiment of consumers to borrow too much as well. Either way, demand will likely be curtailed until interest rates stop increasing and market expectation of further falls in property values changes. But while there's no expectation of a sudden bounce back in activity coming soon, it's worth noting that demand isn't completely non-existent. Deals are still being done, and the latest CoreLogic buyer classification data for July shows buyer activity among each group remains relatively consistent with prior months. First home buyers may be debating whether it's worth holding back in a falling market, but others are taking the opportunity to negotiate sharp prices and get the deal done. Likewise, investors aren't as active as they have been in the past. But with almost 1 in 4 sales going to those still using the bank, clearly tougher regulations and expectations of reduced future profits aren't scaring everyone away. That said, it needs to be noted that each of these market share figures are within the overall context of a lower raw number of sales. Slowing rental growth will be yet another consideration for landlords, however, with the yearly rate of growth falling to 4% at the end of July, much closer to the long-term average of about 3%. This reflects early indications of a lift in rental supply and falling demand as the country's net migration position slips into the negatives. Not much stands still in the property market though, especially when policy and regulation is involved. Make sure you keep across all the latest developments by signing up to our regular releases. Follow us on social media and subscribe to the New Zealand Property Market Podcast, released every Monday afternoon. Mā te wā.